How T-12 statements affect commercial real estate lending, and why property performance determines your ability to refinance into permanent debt. And one of the biggest misconceptions among commercial real estate investors is believing that simply completing renovations automatically qualifies a property for permanent financing. Well, it doesn't. And the lender isn't financing your renovations, they're financing your property's ability to consistently generate income to repay the loan. And that's where trailing 12-month operating statements or a T-12 becomes one of the most important documents in commercial lending. So whether you're buying an apartment complex, a retail center, an office building, an industrial property, or a self-storage facility, your T-12 tells lenders whether your value add strategy has truly succeeded. And if your property has achieved economic stabilization, refinancing into lower cost permanent debt becomes dramatically easier. So, what is a T-12 statement? Well, a T-12, or a trailing 12 months operating statement, summarizes the property's financial performance over the previous 12 months. And it typically will reflect your gross rental income and any other income, and your vacancy loss and your bad debt and your operating expenses and your resulting net operating income, or NOI, but also monthly income trends and monthly expense trends. So unlike a budget or a pro forma, a T-12 reflects actual operating history, and lenders trust historical performance far more than projections. So why permanent lenders focus on the T-12? Well, bridge lenders often finance based on potential, and permanent lenders finance proven performance. So by the time you refinance, lenders want evidence that your business plan has worked. And questions they ask include, has occupancy stabilized? Are the rents sustainable? Are expenses under control? And is the cash flow consistent? And can the property comfortably service the new loan? Well, the answers are found inside the T-12. The value add timeline. A typical value add investment follows this progression. Step one is acquisition, and the investor purchases an underperforming property with low occupancy or below market rents. So some examples could include properties with deferred maintenance or poor management or vacant units or under market leases or operational inefficiencies. Step two is bridge financing, and bridge loans provide the flexibility needed to execute the business plan. And the capital is used for renovations. It's for leasing commissions and marketing and capital improvements and tenant improvements and operational improvements. Step three is improve the occupancy. And as renovations are completed, vacancy is going to decline and tenants will renew. And new tenants will lease any vacant space. And rental income increases. And occupancy begins to stabilize. Step number four, work on increasing your net operating income. And as revenue grows while expenses remain controlled, your NOI is going to improve. And this is the number that permanent lenders care about the most. Higher NOI means higher valuation and better loan terms, and increased proceeds and lower refinance risk. So economic occupancy versus physical occupancy. And many investors only focus on physical occupancy. Lenders don't. Physical occupancy, it's the simple percentage of units that are currently occupied. So for example, if 90 out of 100 units are leased, you have 90% physical occupancy. Whereas economic occupancy is a different concept. And that's the percentage of collectible income that's actually received. And it considers any free rent, any concessions, any delinquencies, any bad debt, and any vacant units. So let me give you an example. Say you have 95% physical occupancy, but only, say, 87% economic occupancy. Permanent lenders underwrite economic occupancy because income and not lease space is what actually repays the loan. So what is economic stabilization? And economic stabilization means the property has achieved consistent financial performance over time. And typical indicators include strong occupancy ratios and stable rental collections and positive NOI and limited deferred maintenance and predictable operating expenses and sustainable rental rates. And this demonstrates that the business plan has transitioned from improving the property to the property performing on its own. So why seasoning matters? And many investors ask, hey, well, we finished renovations. Why can't we refinance immediately? Well, because lenders want to see that the improved property performance is actually sustainable. So most permanent lenders prefer several months of stabilized operations reflected in the T-12 before refinancing. And 12 months is the date before you can use new appraisal value. And this reduces underwriting risk and proves that improvements are durable rather than temporary. So the relationship between NOI and loan amount and commercial loans are driven by income. And as net operating income increases, so does your debt service coverage ratio. And your loan proceeds will also increase, and your property valuation is going to rise, and cap rates create greater equity, and refinance options are going to expand. So even modest increases in NOI can translate into substantial gains in property value. And for many investors, improving operations, not simply renovating buildings, creates the greatest return on investment. So some common mistakes that delay refinancing. And many investors inadvertently postpone their refinance because they refinance before their financials will tell the full story. So some common issues there include that the occupancy hasn't stabilized, or collections remain inconsistent, or there's high delinquency rates, or expenses spike after the renovation, or short operating history, or poor bookkeeping, or incomplete T-12 statements. And every one of those concerns increases lender risk. So how investors can prepare for permanent refinancing. So before refinancing, ensure that your property demonstrates stable occupancy and strong economic occupancy and consistent collections and healthy NOI and accurate financial reporting and a clean rent roll and a well-maintained property and predictable operating expenses. And when these elements align, permanent lenders are going to compete aggressively for the opportunity to finance your asset. So why working with an experienced capital advisor matters. And every lender evaluates T-12 statements a little differently. And some prioritize occupancy, whereas others are going to focus on debt service coverage ratio. And others emphasize debt yield and liquidity and sponsorship strength and market fundamentals. And working with an experienced capital advisor helps position your financial package before it reaches the lenders. So it improves the likelihood of stronger terms and a smoother refinance process. And at CommLoan, our platform provides access to more than 700 commercial lending sources, allowing investors to compare financing options from banks, credit unions, agency lenders, debt funds, life insurance companies, and other capital providers. And that means you receive financing that's matched to your property's actual performance and not a single lender's lending guidelines. So final thoughts for the day. Successful value-add investing doesn't end when renovations are complete. It ends when your property's financial performance demonstrates long-term stability. So a strong T-12 tells lenders the story that they want to hear. Hey, the property's leased and it's cash flowing and it's economically stable, and this is ready for permanent financing. So understanding how lenders analyze T-12 statements allows investors to refinance sooner and secure better loan terms and increase proceeds and maximize long-term returns. So if you're considering refinancing a value-add property, the best first step is a detailed review of your property's operating performance before approaching lenders. So you ready to refinance your commercial property? Well, whether you're exiting bridge financing or planning your next acquisition, I can help you evaluate your property's readiness for permanent financing and identify the right lending solution. My name is Bill Rapp. I'm a CCIM. I'm also a director at the CommLoan Empower program with access to 700 commercial lenders. And I invite you to check out my website at billrapp.comloan.com. You could start a pricing quote and request a call back. And I look forward to a conversation with you soon. Have a good day.